everyone. Welcome once again to week two lecture videos. In this video, I will be talking about repricing model. Put simply, the repricing model or funding a model is essentially a book value accounting cash flow analysis of the repricing gap between the interest revenue earned on a financial institution's assets and interest paid on its liabilities over some particular period. The model is a simple model used by many financial institutions. In Australia, Australian Prudential Regulatory Authority or APRA requires smaller authorized depository institutions to use the repricing method to estimate interest at risk exposures in their banking book for capital adequacy purpose. Under the repricing gap model approach, a bank calculates the gaps in each maturity bucket by looking at the rate sensitivity of each assets and liabilities on its balance sheet. So what happens is the financial institution's manager divide all the assets and liabilities in their balance sheet into different maturity buckets. For example, one day to 15 days, 1 month, 3 months to 6 months. And each of these maturity bucket will include similar maturity assets and liabilities. And under the repricing model, the manager will calculate the difference between the asset and liabilities in each maturity bucket, okay? And that will facilitate an estimation that how an interest rate changes will affect the net interest income. So that's the repricing model all about. Rate sensitivity, as I said, that financial institution manager will calculate the difference between rate sensitive assets and liabilities. The rate sensitivity in this context means the time to repricing of the asset and liability. More simply, it means that how long the financial institution manager has to wait to change the posted interest rates on any asset or liability. Repricing may be the result of a rollover of an asset or liability on maturity or on the reset date of the variable rate assets and liability. Now, you might be wondering, as I said, that financial institution manager divide asset and liability maturities into different buckets. Now, how do we understand, or how do we know about how financial institutions are exposed to interest rate risk? Well, like commercial banks, they are required that they report quarterly the repricing gap in their asset and liability maturity buckets. For example, a financial institution can have a 1 day, more than 1 day to 3 months, 3 months to 6 months, 6 months to 12 months, 1 year to 5 year, and more than 5 year maturity buckets. And in each of these maturity buckets, there will be similar maturity assets and liabilities. Okay, so in any particular date, the difference between the assets and liabilities in each maturity bucket will be calculated, and that will lead us to estimate that how interest rate changes will affect the net interest income of that maturity bucket. So look at this example. Say a financial institution has these 6 different maturity buckets, and each maturity buckets, there are assets, there are liabilities, there are gaps. So gap means the difference between assets and liabilities. You can see for first day, the asset is 20, liability is 30. So asset minus liability, gap is minus 10. In the second case, the gap is again minus 10, minus 15, plus 20. And we also can calculate cumulative gap. Cumulative gap means we are summing up all the gaps. Now, keep it in mind that if we calculate the gap for all the assets and liabilities and we cumulate them, the cumulative gap must be 0, because from a balance sheet perspective, the asset side and liability and equity side must be matched. So the cumulative gap of all the assets and liabilities must be 0. However, we can obviously calculate the gap for a certain maturity. Look at this example. So how do we calculate the effect of interest rate changes on net interest income from this rate sensitive assets and liabilities gap. So what we do is look at this model. In the left-hand side, we have delta net interest income. It means that changes in net interest income. This is gap. So as I already have shown you in the last slide, this is the gap I am talking about, the difference between assets and liabilities, rate sensitive assets and rate sensitive liabilities, and multiplied by the change in interest rate. So it essentially means that given a gap, if interest rate changes by a certain magnitude, how the net interest income will be affected. Okay, so like in our previous example, we had a one-day gap of negative $10 million. Now you can see the gap is negative 10 million. If interest rate rises by 1%, so this is 1% and this is negative 10 million, so this is negative 100,000. So it means that given a one-day gap of negative 10 million, 1% rise in interest rate will reduce the one-day net interest income by 100,000. Okay, so that actually gives an idea that how a financial institution is exposed to interest rate risk. Now we also can calculate it a cumulative gap for a certain period. For example, if you look at the cumulative gap up to a 1 year period, the cumulative gap was $15 million. So once again, this is our cumulative gap. We multiply by 1%, and we see that it is 150,000 negative. So which means that over a period of 1 year, if interest rate rises by 1%, the net interest income of this financial institution will decline by 150,000. So that's again a measure of interest rate risk exposure. So for example, for this financial institution, 1% rise in interest rate will reduce its net interest income by 150,000. Now for another financial institution, if it is 200,000, another financial institution, if it is 100,000, that will indicate the degree to which each financial institution is exposed to interest rate changes or interest rate risk. Now, as I said about the rate sensitive assets, now there are a range of assets in the balance sheet, right? To understand whether an asset is a rate sensitive asset or not, we need to ask a question for each of the assets. Is this asset subject to interest rate change over a period of time? For example, say next 6 months or next 1 year. Is this asset is subject to interest rate changes in the next 1 year, for example? If the answer is yes, then it is a rate sensitive asset. Typically, the rate sensitive assets are short-term consumer loan, 3-month treasury bills, 6 months treasury bill, 30-year floating rate mortgages reprice every 9 months. So if you take 1 year, for example, you can see that this is a short-term 1 year loan, 3-month treasury bill, 6 months treasury notes, 3-year mortgage, but still it is repriced in 9 months. So from a 1 year perspective, all these assets are rate sensitive assets because these assets are subject to interest rate changes within 1 year period. Rate sensitive liabilities have the similar definition. So for each liabilities, we need to ask again the same question, that is this liability is subject to interest rate changes over a certain period of time? Now, if the answer is yes, then it's a rate sensitive liabilities. And generally, these rate sensitive assets and generally the rate sensitive liabilities are different types of deposit. For example, 3-month term deposit, 3-month backless acceptance, 6 months negotiable certificate of deposit, 1 year term deposit, like this. Now, there are some arguments with regard to whether a checking account balance or transaction deposits should be included as a rate sensitive liabilities or not. There is actually against of this argument, or there is also in favor of the argument. There is, it means that there is argument against of inclusion of the transaction deposit as a rate sensitive liability, and there is also argument in favor of inclusion of transaction deposit as rate sensitive liabilities. First of all, if I talk about the arguments against inclusion, the interest rate paid on transaction accounts such as savings and similar account is positive. However, the rates paid by banks on these deposits are very sticky. That is, savings interest rates do not change with the general change in interest rate, and banks tend to change such rates infrequently. Okay, that's why although they are short-term deposits, they are typically not subject to general interest rate movement. So that's why there is an argument against the inclusion of these transaction deposits or savings deposit as rate-sensitive liability. And there is also argument for inclusion. If interest rate rises, individuals draw down, that means, or run off their transaction account deposit, which may force the bank to replace them with higher yielding interest bearing rate sensitive funds. That is most likely to occur when the interest rate on alternative instruments are high. In such an environment, the opportunity cost of holding funds in transaction account deposit accounts is likely to be larger than in a low interest rate environment. Just we have seen that the gap in one of the previous slides. So this gap, I mean the gap between the rate sensitive assets and rate sensitive liability, can also be expressed as a gap ratio. So for example, cumulative gap divided by assets. This is an important information because cumulative gap divided by asset ratio gives an idea about the overall interest rate sensitivity of a financial institution. For example, say that one financial institution has a cumulative gap of 15 million and its total asset is 270 million. So it has a gap ratio of 5.6%. Once again, as I said, that gives an idea about the interest rate risk exposure of a financial institution. Now, another institution with a 10% gap, obviously 10% gap ratio obviously will indicate the financial institution's greater exposure to interest rate risk. On the other hand, another financial institution with a gap ratio of only 3% will obviously indicate a lower degree of interest rate risk exposure of that financial institution. Now, just one point to finish this discussion. As I already said, that we can estimate the effect of interest rate changes on net interest income by this simple formula, which is cumulative gap into interest rate changes. For example, our cumulative gap was $15 million. Interest rate change is 1%. So the effect of interest rate changes on net interest income was $150 million. Now, you need to remember a couple of points that here, the cumulative gap is $15 million positive, okay? So cumulative gap $15 million positive means the rate sensitive assets are higher than rate sensitive liabilities, which means that if interest rate increases, then the revenue from the rate sensitive assets will go up and the expenses on the rate sensitive liabilities will also go up. However, since assets are higher than the liabilities, the revenue will go up more than the expenses goes up. So it means that incremental interest income will be higher than incremental interest expense. As a result, net interest income will go up. On the other hand, in our previous example, the cumulative gap was negative, which meant that liabilities, rate sensitive liabilities are higher than rate sensitive assets. So as an interest rate increases, the expenses, interest income, interest expense on the liabilities will go up more than interest income from the assets. As a result, the net interest income will be negatively affected. So if you remember that in our previous example, the change in net interest income was negative. And another point is this model or this formula can only be used if interest rate change is same for the rate sensitive assets and rate sensitive liabilities, right? So when I say 1% rise in interest rate, I implicitly assume that interest rate increase for both rate sensitive asset and rate sensitive liabilities. However, what if that interest rate changes differently on the assets and liabilities? This is also rational to think that interest rate on assets and liabilities might change differently. And in that case, we actually cannot use this model. We need to use this model where this is rate sensitive asset multiplied by change in rate sensitive interest rate interest rate on the rate sensitive asset, and this is rate sensitive liabilities multiplied by interest on rate sensitive liabilities. And then we find out the effect on net interest income. So the bottom line is to find out the effect of interest rate change on net interest income, we first calculate gap and we multiply it by the change in interest rate when the interest rate change is symmetric for both assets and liabilities. However, if the interest rate change is asymmetric for asset and liabilities, we use this model. Okay. So just to summarize that repricing model is a book value based model and which calculates the effect of interest rate changes on net interest income. If gap is positive, a rise in interest income will have a positive impact. A rise in interest rate will have a positive impact on net interest income. On the other hand, if gap is negative, then a rise in interest rate will have a negative impact on the net interest income. And the opposite is true for a decline in interest rate. So that's all our discussion about the repricing model. And in the next video, I'll be talking about the weaknesses on repricing model. Thank you very much.